Welcome to this session. Today we will start adjusting journal. You know that journal entry generally two types: general journal and special journal. General journal we can divide it five category or under five head. Out of this head, general adjusting entries or adjusting journal is the second position. So now I am going to start adjusting journal. Basically, adjusting journal, adjust means accommodation or adjusted current year. This journal basically start to update the balance of trial balance. At the end of accounting period, we just try to maintain such types of journal. And this journal actually they try to maintain accrual basis. So there are mentioned clearly definition. Adjusting entries refer to a set of journal entries recorded at the end of accounting period. This is the crucial point. At the end of accounting period, these journal are needed to posting. And another option to have an update the accuracy balance of all account to know the update of trial balance. This is the another issue. Update the balance of all account, another criteria. And finally, adjusting journal try to follow accrual basis of accounting. Accrual basis of accounting, you know that accounting there are two bases. The accounting operation deal with two bases. Number one, cash basis. Number two, accrual basis. Cash basis means when you cash payment and cash receipt in this time need to record, but accrual basis you just recognize expense or income, and cash payment will be occurred in future. Cash payment will be in future, but you have to currently recognize expense or income. This is the accrual basis. So accrual basis, absence of cash, and cash basis, priority cash. When you deals with cash payment or cash receipt, in this time need to record expense or income. This is the cash basis. So accounting follow two basis. Number on cash basis, number two accrual basis. Cash basis mean when cash payment or cash receipt, in this time you have to recognize expense or income. And accrual basis, absence of cash. Cash payment will be settled in future. This is the accrual basis. So to be adjusting entry, there are must be three criteria. Number one, adjusting entry made at the end of accounting period. Number two, to know the update of all balance of all account. Number three, adjusting entry follow the accrual basis. This is the three main criteria to be adjusting entries. There is a special journal, no need. Thus, before class, I have discussed another definition of adjusting entry. Same definition before slide and current slide. Okay. Now, why adjusting entries are needed? Why adjusting entries are needed? So, adjusting entries ensure the revenue recognition and expense recognition principle are followed. Revenue recognition and expense recognition principle are followed. That's mean No priority of the cash, just expense or income incurred, you declare it is expense, it is income, and settlement by cash will be future, no problem. You just recognize. And second point needed for adjusting entry. Adjusting entries are necessary because the trial balance may not contain up to date or complete data. Trial balance sometimes not update. Trial balance sometimes may be mistake. So to know the accurate balance or to know the update balance, you have to need post the adjusting entries. Another option, the importance of adjusting entries. Adjusting entries are required every time a company prepare a financial statement. To make a financial statement, you have to post the adjusting entries. This is the burning issue or important or necessity of needed adjusting entries. Now I am going to another very important slide of adjusting entries. Types of adjusting entries. Adjusting entries are two types: accrued and deferred. Accrued means cash payment or cash settlement will be in future, and, and deferred cash payment in advance, cash receive advance, cash payment advance. This advance transaction, this is the called deferred. And another option is accrued. Accrued means cash payment in future or deal with cash in future. And deferred means cash is advance. So this accrued may be income or revenue, may be expense, and deferred may be expense and income. So this is the very technical point. You have to clearly understand this point. Accrued and deferred. Accrued and deferred. Accrued mean outstanding, and deferred mean advance. Okay. So accrued may be revenue, accrued may be expense. Side by side, deferred may be expense, may be income. If income deferred, definitely will be liability. And expense are deferred or advance, it will be asset. So expense deferred means advance. Okay, you mind it. Deferred means advance or prepaid. Advance or prepaid. Advance, prepaid, and deferred. Three words are same. Three words are same. So you try to mind it very clearly. Deferred, advance, prepaid are same. So this deferred, this prepaid, this advance may be expense, may be income. If expense will be deferred, advance, prepaid, it will be asset. It will be asset. Okay. And again, if income will be if income will be deferred, advance, or prepaid, it will be liabilities. Very clearly, you have to realize or understand, try to understand clearly. So accrued and deferred. Accrued and deferred. Accrued may be income, may be expense. Deferred may be income, may be expense. Deferred income will be liabilities. Deferred expense will be asset. Same to accrued income will be asset. Accrued expense will be liabilities. So you clearly try to understand about this technical point to understand adjusting entries. This is the concept or core concept of adjusting entries. Some information or highlights by the slide needed, meaning, and benefited. So now I am going to discuss about types of adjusting entries are more clearly or more simplified are highlighted by this bottom of the slide. Types of adjusting entries: accrued revenue, accrued expense, deferred expense, deferred revenue. Okay, and depreciation expense. No need, bad debt, doubtful account or bad debt, no need. You just try to understand this four category: accrued income, revenue, accrued expense, deferred expense, deferred revenue. These four category or four types of adjusting entries. So accrued revenue will be asset, accrued expense will be liabilities. Same, deferred expense will be asset, deferred revenue will be liabilities. You have to clearly understand this four criteria. Again, I clearly mention adjusting entries occur before cash. Accrued expense is equal to liabilities. Accrued revenue will be asset. Accrued expense will be liabilities. Accrued revenue will be asset. Again, deferred or prepaid or advance same. Prepaid or deferred expense will be asset. Unearned and deferred revenue will be liabilities. This is the criteria.